But look at a business that's like a $200,000 business, a $300,000 business. A $300,000 business might have $150,000 in cash flow, plus the fact that he's a genius and he was able to play a really hard game. If you're constantly looking for how sexy something is, or you're constantly looking to justify your decision versus poke at your thesis, I mean, that's someone I would never trust with my money. So what would I avoid doing? What would I not do? They know they're probably not a crook. You know, they're probably not going to steal their money from them. We're wired to see patterns. We're wired for predictability. So when something feels uncertain and unpredictable, it creates a level of anxiety for people.
Welcome to the Leverage Podcast, where we give you men's dating advice that doesn't suck. I'm your host, Robbie Kramer, a personal growth junkie and dating coach for over 15 years. Tune in each week to learn the latest and greatest strategies to get more dates, make yourself more attractive and confident with the opposite sex, in order to meet your perfect 10 and design a lifestyle that makes all your buddies jealous. If you're a regular listener and digging our content, please leave us a 5-star review on iTunes, Spotify, Stitcher, YouTube, wherever you watch this or listen. But if you don't feel like it's worthy of 5 stars, just go ahead, don't leave any review at all. And that'd be great. If you're new to the show, I recommend you download my free dating protocol, which will help you optimize your first dates. I like to connect with my listeners personally, so send me a message on Instagram, say hi, and I'll send you over that PDF to download. You can find me on Instagram at Robbie_Kramer. That's ROBBIE_KRAMER. So before we dive into this week's content, I want to let you guys know we've opened up a few slots in our exclusive mastermind program called the Leverage Program. We're accepting applications if you want to join our select group of men and experience the radical power of accountability, stop procrastinating on your goals, cross everything off your sexual bucket list, become a beast who gets more stuff done. To learn more and apply, go to innerconfidence.com/leverage.
And we're back. We are with Eric Schleien, the portfolio manager of Granite State Capital Management. Eric's been in the game for a while. Also, I've known him for a long time. And he's always talking about very interesting sort of investment strategies and mindsets. So I'm super stoked to have him on to share his wisdom with us today. Eric, thanks for coming.
Thanks for having me on.
So tell us, how did you get into your line of work?
Well, it's been a while. It started actually, I was with my mom at a bookstore. So back when I was a kid, the one thing my parents would buy for me pretty much if I wanted was books. They were very supportive of me being as educated as possible. And so I was in a bookstore. I was about 14 years old. And I decided I want to go be a big boy and go to the most mature section I could find, which was the business section. And I found a book by The Motley Fool, and it was like a teen's guide to making more money than your parents ever dreamed of. And that for me was very enticing as a teenager. So picked it up, started reading it at the bookstore, and talked a lot about like a lot of personal finance concepts, like don't go into too much debt, don't spend everything on a credit card, and, don't spend more than you earn. But then they showed a compound interest graph. If you, have $100,000 or you have $10,000 and you compound it for 50 years at 10%, it's a lot of money. And my first thought, and this is verbatim, the thought that I had was I could be a loser and work at McDonald's my entire life and still be, a millionaire. And the insight that I had is I had to be able to be consistent long term, because if you do the math, if you have permanent losses of capital, say 3 or 4 times at 50%, it really destroys performance over a 5-decade period. So what
would that be, where you're not contributing to your
well, it would be so let's say and again the reality never looks like the perfect math, because if you do 10% annualized over 50 years, there's probably going to be very few years where you've actually done 10%, right? So it's a lot lumpier than that. But just to make things simple, if you had 50 years of returns of 10% versus 47 years of 10%, and then 3 random years where you've lost 50%, the difference in that number is gigantic. I don't remember it off the top of my head, but it's a lot. It's a lot. So having the insight that I had to be able to do this long term, and I had to figure out a way to not lose a lot of money over the long term, and that very much resonates with what Warren Buffett says, right? Which is rule number 1: don't lose money. Rule number 2: don't forget rule number 1. So I decided to start reading about the investors in the book, and the first person I read about was a guy named William O'Neill. He is the founder of the Investor Business Daily, and was clearly a smart guy. But I just there was so many charts, and it was so fancy, and I just remember thinking, there's no way I could do this over a long period of time. This is so intricate and so complicated. Then the next person I read about was Peter Lynch, who's a genius. And I came away, I think the biggest thing I got from reading his stuff, and he's a great writer too, I highly recommend his books for new investors, was really being able to see the stock market is a supermarket of businesses, not just, a bunch of, tickers going up and down. These represent real assets, real liabilities, real cash flows. I also came away with the takeaway that I didn't think I could replicate his career. I didn't think, the market did very well during the time period he was investing with Magellan. And he would own like 1,000 stocks at a time sometimes, which is, I think, the only person I can think of who's actually done really well owning that many stocks.
Was he just like a beast who spent all of his time researching these companies?
Yeah, he'd research. He'd fly around the country visiting these businesses. He also discovered some pretty big companies when they were tiny. So there was a lot of things he did right, where if he didn't do those things, you wouldn't have had those returns, right? So if he hadn't discovered some of these small companies, if he hadn't been traveling all over the world, or if he was in a different time period where the market wasn't as good, surely his track record wouldn't have been as good. So there was a lot of things going for him, plus the fact that he's a genius, and he was able to play a really hard game. I think what he was doing was very hard, and make a lot of money. So I just didn't think I didn't think I would be as good at that game and I still don't think I'd be good at that game than he is. So,
and he probably had a team of people helping him as well, right?
I don't know, actually. That's a good question. I don't know how many people were actually helping him with that.
Okay. Is that common for people, I guess, portfolio managers, or to have like a big squad of people that are helping with the research, or they're more like a one-man show?
It's so a little bit of both. It depends on the shop. Most of the investors who are pretty famous, who have the very long-term track records,
like Buffett, for example.
Yeah. So like Buffett, for example, he does have 2 portfolio managers now, but they were really brought in to, take over when him and Munger died. But before Todd Combs and Ted Weschler were at Berkshire, which that's an amazing story of how they ended up joining. But I think he had like Britt Tracy Cool was like an analyst there. So I think he had like one analyst at Berkshire,
Okay. So
managing a multi-billion-dollar portfolio. There's a guy named Seth Klarman. I know he does have a team of people that he works with, but generally these people do all their own thinking, most of their own research, and the analyst is there to say, hey, can you go to this company, or hey, can you look for, just look through some filings for me. So it's more of taking away some of the grunt work.
mm-hmm.
But generally when you have like investment committees, so to answer your question, a team of people or investment committees are actually much more common than an individual, but the investment committees are generally more of like the large corporate types of businesses, or even some large hedge funds. But the people that end up having the superior track records, very few of them have investment committees.
Interesting.
Yeah.
Okay.
Part of that too is, like if I hired an analyst, for example, not to do grunt work for me, but to actually generate ideas for me, it would be kind of a weird dynamic, because it's very likely that I could just say no to the guy or the gal for like 3 years straight, and they just give me ideas and I just keep saying no to them, and it's not even, it wouldn't even be a reflection that the idea is bad,
Right.
but if someone is so good at research, they're actually better off. You're better off just giving them capital and let them do their thing and not talk to you.
Interesting.
Because that's
Yeah.
my view anyway. Because my view is, if I hired somebody, they're gonna have a different competency set, understanding of the world than I do. So, one of my competitive advantages is I can see things and opportunities that other people can't see. Well, if they're that smart, they're going to see things that I can't see.
Right.
So it's likely that some of their best ideas I would disagree with, or I would not be comfortable investing in, which is why it's a good idea.
Right. How did you develop that intuition or that ability?
I don't know.
Skill, I guess, is a better way to say it.
I don't know. See, I don't know how much of it I was like born with and how much of it was learned. I've always been someone who, so I think that the natural tendencies that I have very much worked for me, where I've always been interested in understanding how things work, on being a truth seeker. I kind of hate that word. I cringe even when I say it, but trying to really understand like how to be as objective as possible, and in reality. So I've never had the kind of resistance to challenging my beliefs as most people do. That is a huge advantage psychologically. If you buy a stock and then you talk to all your,
you can kind of take your ego out of the equation pretty easily.
very, very much so. Yeah. And a lot of people will buy a stock, talk to everybody about it, and they're looking for confirmation on why they're right.
Right.
I'm actually trying to look to see where I'm wrong. And then I think the other thing, though, is that being in sort of an environment of other investors doing fundamental analysis, I'm around other people that have that kind of mindset, and I'm kind of turned off by people that are more promotional, or, talking about like, oh, I like this piece of real estate, or I like this, or I like Tesla, and again, regardless if it's a good investment or not, there's a certain kind of mindset where if you're constantly looking for how sexy something is, or you're constantly looking to justify your decision versus poke at your thesis, I mean, that's someone I would never trust with my money. So I and then also, and the other thing too is it makes you more money if you can see where you're wrong, because it makes your thesis stronger.
Right.
So I think part of it was innate, and then part of it has just become habitual with the environment that I'm around.
Gotcha. So circling back to kind of your beginning story, how did you tell us about like your first deal? How did you generate enough capital to start, your company?
So to start my company, or just to make my first investments? So that's a different thing.
Whichever one you think is more.
Yeah. So when I started investing, it was a little money that I had saved up. My first investment was like, a $1,000 investment in Apple, and I thought it was a genius when it doubled, and I sold it for about so I got about $2,000 for my Apple shares. That would be worth, like over $300K today. But then the way that I raised capital to start my company is I had been doing this, for, I made my first investment in Apple, and it's 17 years old. It was actually in my dad's brokerage account, because I wasn't even old enough to open my own account yet. I remember my 18th birthday, the day after my 18th birthday, I opened up an account with TD Ameritrade. So I've been doing this literally since before I could legally own my own account. And I had my very first investor, who I can't, for privacy reasons, I can't say who it is, but they do like angel investing and stuff like that. So not the typical person I would think would invest with me. And I had actually had an idea for a business. And I had known him. I really respect the guy. The guy's brilliant, and he's invented some cool stuff. MIT graduate. Him and his wife both are actually MIT graduates. But the I was sitting down with him at this restaurant that he owned, and I was pitching him this business idea that I had, and he hated the idea. But he said, that investing stuff that you do and you kind of want to start, maybe we should sit down and talk about that. And I was like, great. So a few weeks later, I was supposed to meet with him, and I had almost forgotten about the meeting. It was just like, because it was really early. I'm not a morning person. I've never been a morning person. And on an hour of sleep, I rush over back to the location, and I was wearing, it was the most ridiculous outfit. I was wearing like those tight Under Armour like workout clothes, and I hadn't showered, but I didn't want to be late for the meeting. So I was on an hour of sleep, probably smelled terrible, wearing like spandex workout clothes. And I showed up and we discussed more about my investment strategy and what I do. And he said, I'd like to give you $100,000. And I said, great. And then a couple of weeks later, he said, I'd actually like to give you $200,000. And I said, okay, great. And he was my first investor.
Wow.
And that made it a bit easier to raise more money because, someone else had already taken the plunge. It's always the first person's always the hardest. And then it was just like talking to people, and people generally know this is what I do and this is what I'm passionate about. And I think it kind of self-selects. Like my marketing strategy literally is just have conversations with people like I would anyway. And I'm really fortunate, but I've ended up attracting the right kind of people who tend to be more business minded, business savvy, long-term thinking. A lot of my investors are actually pretty good investors themselves, and they could technically do this themselves. They just don't want to.
Is that because they're busy running their own businesses or focusing?
Yeah, or it's just they don't. This is not their thing,
right?
But
so you have this passion for analyzing companies, looking at deals. That's like you wake up and you're excited to do that.
That's right. I was at one of my investors. I was at his house a few years ago, and I was sharing with him an analysis of this business I was really excited about. I had not had an idea this good in years, and this is 4 or 5 years ago now. And I'm just sitting down with him on the analysis, and after we get through it, he goes, you don't ever have to do that with me again. That like, I'm bored to tears, but I'm so glad this turns you on.
I can relate to that guy.
Yeah. So
but
I love that because that's right. That's right. So it was nice. And it also gave me the comfort that I don't need to, analyze every single investment before I buy it for my investors, that they trust me that I'm doing the work. Gotcha. Myself, and if I screw up, which I do on occasion, when I say on a lot actually, I'm very upfront with my investors, like, hey, I made a mistake here, I screwed up here, and I actually speak about that first. But yeah, that's kind of how I've raised money over time.
When you're looking at potential deals,
do
you have like a sector that you look in first, or are you kind of just open to anything, any size company, any like exit strategy?
Yeah. So I'm a generalist, meaning that I'll look at anything. And this is me personally. Everyone's going to be different, right? Like, you look at a guy like John Malone who runs Liberty Media, right? The only thing he's invested in since the 1970s are like cable companies and media companies. There's a great book called Cable Cowboy about him, and he started with TCI in the 70s and right on the verge of bankruptcy. The guy's done like 40% annualized since the 70s. It's like one of the best investment track records in the world. The guy's a billionaire, and he's only invested in one sector, media and cable. And then there's people like me where I will look at pretty much anything that I can wrap my head around. So I guess you could say if something's over the top complicated, I'm just not going to waste my time with it because it's, or I'm not going to look at like speculative stuff. So, if there's like a pharmaceutical company that has one drug in a trial run, I'm not going to buy something with the hopes that it's going to be successful. I don't really buy IPOs. So I'm not doing, I guess I'm not doing that, but anything else is pretty much fair game. I prefer the United States, but I will look outside the United States if something is a really good bargain. I prefer large, stable companies, but I often invest in very, very tiny companies because there's better opportunity sets available with those businesses. I like the sweet spot would be I can buy Coca-Cola at 4 times earnings, but that's never going to happen. So, like I gotta roll with what's available to me.
Right. And are you looking? Where are you finding deals? Are these just like word of mouth sort of things? Here, stuff you hear from your contacts? Are you like doing research online a lot of the time?
Yeah. So my first thing, which your listeners probably won't like, so Buffett has said, one of his keys to his success is he tries to read 500 pages a week on anything. So I've been doing that, for years. I not every week I do that, but most weeks I'd say I'm pretty around there. I read, most of my job is reading and learning. So sitting on your ass and reading is a competitive advantage because most people aren't doing that. Actually going through an annual report. It's amazing how many people invest and have never read a corporate report, or they read the sales presentation and that's it. Like actually get your hands dirty and start reading corporate reports, especially with the smaller companies where no one's looking at that stuff. And then,
and just to clarify, corporate report would be all of the financials, right?
Yeah, like the quarterly reports, the annual reports, reading.
So you kind of have to know what you're looking for, at least a basic level.
No, I don't know what I'm looking for. Like I'm reading things that interest me or that I find interesting.
Meaning, like you need to know what a balance sheet looks like and how.
Oh well, yeah. I mean, if you don't understand basic accounting, you're not going to be able to. You need to have a basic understanding of the fluency of the language of business. You don't need, but you don't need to be an accountant. That's right. I think that's the other thing. Is like it's not that hard to read a balance sheet when you learn that. It's not that hard to read a cash flow statement. If it is hard, that might be a red flag that there's something going on. I'll tell you a story. Yeah, I'll tell you a story. So when I was in high school, I kept an investment journal that I actually found recently, and I was talking in 2005. So I think 2005. Oh, either 05 or it would have been 05. It was 2005, and I'm writing about looking at Fannie Mae, the company, and how I'm trying to read the annual report. There's arrows going all over the place, and the business makes no sense to me. And then I look at the bonds and they're rated AAA, and I don't understand how these are rated AAA. Like the whole thing. So it was like interesting, right? Because all of this stuff crashes, a few years later, and the whole thing that Moody's was misgrading these bonds, and Fannie Mae obviously became a horrible disaster. But as a high school student, you don't have to be a genius to figure out they're intentionally trying to make this confusing for you.
Right.
So some of the best businesses you'll see, it's a very simple numbers. And so simpler, the better generally. But yeah, if you can understand basic accounting and how to read books, reading financials, then it's just reading and figuring out what you're comfortable with and what you're good at and maybe what you're not good at. So I always tell people, start with companies that interest you. I when I was in high school, I there was a book called Warren Buffett Wealth. That was actually the first book about Buffett I read. So when I was saying I read, William O'Neill, Peter Lynch, the third book was Warren Buffett Wealth, and that was where the light bulb for me really clicked. And at the back of that book, I just wrote down a bunch of companies that were interesting to me. It was like Amazon and eBay and Nike and Coca-Cola, a bunch of these, Caterpillar. and you'll start to figure out like what is interesting to you, what makes sense to you, what you can understand, and then you just keep reading and go down rabbit holes.
Gotcha.
Yeah.
So most of the guys listening to this podcast are guys who've done really well in their careers, and they're looking to do really well in their dating life. They're doing good with their dating life. They're looking to do really well. So doctors, lawyers, executives, those sorts of types. What is your advice for sort of that archetype of guy if he's making pretty good money, wants to invest some of it, isn't really hands-on or doesn't really know a lot about investing, you could say.
Yeah. I'll tell you the first thing, which is what not to do. I always like to start with inverting the question, right? It's like, if you want to, Charlie Munger always says, if you want to be happy, figure out what makes you unhappy. He'll say, he always goes, I want to know, he goes, I wish I knew where I would die, so I never go there.
That's funny.
Yeah. So inversions or using inversion as a principle to solve problems is great. So what would I avoid doing? What would I not do? Not listen to most of your friends in that kind of circle, because I find a lot of those sort of high level people, made in their career, that sort of archetype. Well, there's exceptions, obviously. They tend to be friends with lots of entrepreneurs, lots of high tech people, and they tend to be interested in kind of very sexy stories. So, out here in, I'm about a half hour north of Austin. There's a lot of people who, have invested in Austin real estate because Austin real estate has done very, very well over the last 10 years. And the problem with Austin real estate now, it still may be a good investment going forward, but the prices. So there's the calculation called cap rate, which is the income the property will make divided by the purchase price. The cap rates have come down so much that you really need really, really high price appreciation in that house to make money. So I would put that in the speculative category. And the problem with that is that, you could say everyone knows the Austin population will continue to grow. But that's a no-brainer. Everyone knows that. So the price is already reflecting what everyone knows. So it doesn't inherently mean it's a good investment. So people who are attracted to very sexy growth stories tend to do worse than, if you just put your money in an index fund. Even if you look at people who are doing like high level, like venture capitalism and private equity is underperformed the index over many, many decades by like 2 or 3%.
Right.
And they're doing all this work and crazy, and you could have just gone to sleep for 50 years and had a better return.
How does it stay to like a thing given all that?
Well, it stays a thing because no one really thinks they're average. It's like if you ask a group of people in a room if they think they're a better than average driver, like 90% of the people raise their hand.
Right.
Which of course is impossible. So, I think most people are under the delusion that, if you say you're new in private equity or venture capital, well, I'll be able to figure out who's gonna, make it, or what businesses will make it. I have an edge. Most of the time they don't have an edge.
Yeah.
Most of the time, and you could have a monkey shooting darts at random venture capital companies and it would do just as well. So I think that, the general rule of thumb is that high growth businesses tend to be worse investments over time because you're paying too much of a price for those businesses. So if you're attracted to sexy stories and sexy companies, you're very likely to do worse than average, and it sticks around because people only talk about their good investments. Look, people talk about people talk about winning the lottery, right? You can read newspaper articles. It doesn't mean that playing the lottery is a good choice. It's a very bad choice. Yeah. But you don't hear about the millions and millions of people who lost the dollar. You hear about the people that won Powerball. So same thing with investing. Like people tend to not talk about the times when they lose money. They only talk about their winner. So it makes, if you look out there, it's kind of like Instagram, right? You have a bunch of Instagram models and people doing it's like, oh my God, everyone has an amazing life other than me. It's like, hello, they have filters and that's not their life.
Right.
Same thing with investing. It looks like everyone's doing all these interesting, sexy things. And then there's the whole FOMO that comes into play, the fear of missing out. So you pay higher and higher prices. And this is why these sexy growth companies, it's often this game of hot potato. You'll kind of buy it and sell it to someone else at a higher price. Eventually the party's over.
Right.
And when the party's over, it's very painful. You
could be like that the crypto run up in the end of 2017.
Yeah.
Yeah.
And again, I have no idea if certain, crypto coins end up being a good investment or not. But when everyone is in some idea, that tends to be a bad sign. Right. You don't want competition. So ideally, if you want to make money, go to places where there's less competition. Go to places where you actually have an edge. And places where people would have an edge is typically, not always, but typically with smaller businesses that people are not looking at as much. When the less liquidity in the businesses, the better, because people will pay up for liquidity. And if you don't need to sell next year, who the hell cares if you have liquidity? So there's like thinly traded stocks. They can often you'll find better opportunities there. And even if you go on to like a biz buy sell website, and looking at private companies, there's some businesses that you can buy for like 3 or 4 times earnings. You might have to put 10 hours of work a week into them. But you can get some great valuations if you want to put in some work. If you don't want to do any work, then I'd say stick to the stock market.
So this is probably a dumb question, but can you explain that liquidity thing?
Yeah, sure. Yeah, sure. So if you were to go on to here, I'm gonna just pull up.
You said Finance. Having less liquidity is better.
Not inherently, but you're more likely to find more opportunity. So like right now I'm looking up Coca-Cola today.
Okay.
Right. And
you can share your screen if you want.
Oh no. Okay. It's an ad playing. So right now the volume today is 6.9 million shares have traded. So, to put that in perspective, 6.9 million times 60. Just do some math real quick. So that's like $414 million of that has traded today. That's a lot of liquidity. It's a very liquid asset. Mm-hmm. You could literally have purchased $50 million of Coca-Cola stock today and would have had many shares left over.
Gotcha.
Now there's another company. So my largest holding, which I'm not going to publicly say on the air, but if I was to look at the liquidity of, it's either my largest or second largest holding, depending on the account that I manage. But so there's a company that is one of the largest holdings. It trades at a little under $10 a share, and there's 262 shares that have traded today. So it's, to give you the exact math on that, $2,554.50 of stock has traded today. That's nothing, right? If you had $100,000, you couldn't even put that into the stock today.
Right.
And there's companies where 0 shares trade, and sometimes they only.
Is that a publicly traded company?
Yeah.
Okay.
I've invested in publicly traded companies before that trade like 3 or 4 times a year. That's rare, but I've seen that too. So, we're used to looking at like Googles and Coca-Colas and,
Is that just because no one really knows about them, so they don't really do a lot of trading?
Less people know about them. Analysts typically aren't following them, but they're also smaller. So there's less money available to trade.
Right.
If you had a $30 million publicly traded company, it would be mathematically impossible. Well, not mathematically impossible, but for $60 million of shares to trade a day, that means 100% of the company would have to exchange hands twice in one day.
So yeah, you're dealing with changing of CEOs and boards and everything with that.
It'd be ridiculous. Yeah, it'd be ridiculous. So, and now again, that doesn't inherently mean that that's a good investment. but I like to look at pockets of the market where I feel I will have an edge. So that being said, I do own some shares of Google. Right? Google's a large company and they are very, very highly liquid. I just happen to think when I do a valuation of them that they're a good investment today. But most of my time is not spent looking at those businesses. I'm spending probably 95% of my time looking at very small things because it takes more work to search for that. And there's more manual work that you have to do with that too. Google does not have a hidden asset anywhere.
Right.
But some of these other businesses, they might have a piece of real estate that's misunderstood, or a new product coming out to market, and there's just less. Bless you. There's just less understood about it. And there's not news. There's not going to be many news articles on it as well. The other place where I think people have an edge is looking at businesses where the headlines look really, really bad. Journalism today is all about getting clicks. That's what makes money. And there's the unfortunate part about that is that headlines can be very misleading. They often are. But the fortunate side of that is if you're an investor, the articles about temporary problems in businesses are way scarier than they used to be. So if there's a company that's so hated in the news, that's a place to look. Now, again, maybe the stock's down and it's not actually that cheap, but sometimes you might find that if you were to try to value that business, it's actually vastly different than what the stock price is. So I have found opportunities like that before as well.
Cool.
And part of the reason that opportunity exists is there's very perverse incentives in the financial investment management industry. So like if I was working for a large firm, and say I underperform the market for like 4 or 5 years straight, which could happen. It has happened before. I would get fired from my job. Right. So if I owned like 500 stocks and I was down when everyone else was down, up when everyone else was up, when I'm up, I'd say, look, guys, we made money. When I'm down, I'd say, well, everyone else is down and I have job security. So even if you're right, if you look wrong for a few years and you work for a larger firm, you may get fired and then you don't make any money from that. So
you got to be more careful, right?
Yeah. I've seen situations where, there was an oil and gas security during COVID in 2020 that was really cheap. It didn't make sense, the price. And I really thought I was missing something. I was like, this seems too obvious. So I called up a friend of mine who is a bond trader and, was familiar with the bond. I said, am I missing something? Like, he goes, no. I go, so why don't you own it? He goes, because it would make the firm look bad. And that was everything I needed to know. So if you don't have clients who are super short-term oriented, or if you're an individual investor who doesn't have clients in the first place, you can take a much longer-term approach to these kinds of securities and make a lot more money than people who are kind of forced to be more short-term oriented about their investment decisions.
Gotcha. What would you say? So if some guys like deciding whether to just put a bunch of money into like an ETF, like at Vanguard, for example, or hire, a firm like yours to manage it, what would be the pros and cons? Why would someone choose one or the other?
So I would generally say not to go with someone like me. I mean, I know this is like horrible marketing, but generally you should probably just own an index fund that's low cost and call it a day. The problem with people in my industry is, and it's I don't know how, if there's any resolution to this. As I said earlier, most of my investors are pretty sophisticated. If people who are not sophisticated investors, I mean, you think I'm smart, but who the hell knows? Maybe I'm just talking out of my ass. So for me, right, I'm running my own firm, right? I'm by myself. Most sort of average Joes would just pick someone who works at like their local bank, who's an investor, who's a wealth manager, has an institution behind them. They don't know the difference anyway. So they at least assume, well, there's a big institution behind them, so it's safer.
Yeah.
And if they make money, even if it's not great, they know they're probably not a crook. They're probably not going to steal their money from them. So most people who want just general wealth management end up going with people like that. And the analogy that I use is, let's say I was gonna look to scout, NFL quarterbacks, right? So I'd be going to these colleges or high schools and looking at the football players. Now, I don't know anything. I mean, I know fantasy football. That's about the extent of it. But if I went to any high school or college and looked at the quarterback, I'd look at everyone and be like, "Wow, they're amazing. They're so good."
Right.
Because I have no mental models. I have no filters for what actually makes someone an NFL quarterback. So the only people that could really distinguish the good ones from the not so good ones would be people who are like professional scouts.
It's interesting. It's kind of like dating coaches. A lot of guys, there's a lot of dating coaches out there, like myself, of course.
Right.
And usually a guy who's trying to pick a dating coach is not qualified to make that choice of who's good and who's not. And
that sounds about right. Yeah.
Yeah.
I think coaches in general, right? I mean, look how many garbage coaches are out there. And I'd say for every like great coach who's doing really good stuff, there's a lot more that just, slap the label coach on. For the average person, you don't necessarily know the difference.
Right.
So it's a real dilemma. I would say there are qualities, if you wanted an investment manager that you think could have some kind of edge, I think the qualities you'd want to look for, and I'm completely biased in what I'm about to say, but if I didn't fit this criteria, I would still say the same thing anyway. It's just funny. It reminds me of a story. Years ago, there was a girl, she ended up being my girlfriend for a little bit, but before she was my girlfriend, when I had met her, she was dating this guy. And I basically, she was hanging out with me in my apartment one day, and I said, I'm very biased in saying this, but I think you should break up with your boyfriend. And I'm biased in saying this because I'm attracted to you and I like you. But even if I was totally not attracted to you at all, I would still tell you this right now. So same thing here. You want to find. I mean, I guess it did, yeah. But you also don't want to.
That take for her to break up with him.
A few months.
Was she like, "Wow, you're right. Hey, Joe, we're done."
It was a few months. It was a few months. But I don't know what would happen. And also, if you're listening, don't use that as a tactic, because then it'll become a tactic and be weird. So, reminds me of your. Do you remember your Minnie Mouse story?
Yeah,
or Mickey Mouse or whatever. Yeah, it reminds me of that. But
I called her Minnie Mouse and she liked me because
that's right. That's right.
I thought it was the Minnie Mouse, but actually she was just on the rebound and right place.
That's
right.
Time. So,
I
still remember that story. When I was in college, I had a radio show and I interviewed you then for that. But I digress. So I would look for someone who is first on the younger side, right? If you hire someone with a good track record who's 85, there's not much runway left. That makes it hard because the people with the good track records tend to be much older, and they also tend to have a lot of money. And that's the other thing is, what someone could do with $1 billion is not going to be the same as what someone could do with $20 million. It's a different game. And it's harder at a lot harder at $1 billion than it is at, say, $10, $20 million that you're managing. So you want to look for someone who's more boutique, who's on the smaller side, who has a good track record, also on the younger side. You want to look for someone where their fee structure tends to be aligned with the investor, because you don't essentially want your wealth manager to be getting rich off you. You want them to get rich with you. And then someone who also, and this is more of a qualitative thing, seems to be very ethical in business. I'd say so. This kind of stays away from being super promotional, not trying to be pitching stocks all the time. Does their own work, does their own research. If you have a whole investment committee, that's something to be worried about. Mm-hmm. Generally invest in managers who are going to create more concentrated portfolios for you will be better than someone who has a super diversified portfolio, because at that point you should just go buy an index fund and get the same performance but without the fee. So there's a bunch of these nuances, and then actually sit down with a person and really see how they think about things. And if they can explain things simply to you, that shows there's some real thinking there. Any of these guys giving these like super corporate presentations and it's so over the top complicated, it's because it's to confuse you, to make it seem like they have some secret sauce that you don't have.
Right.
The
Red
best
flag.
investors will show you exactly what they do, and you could replicate it if you wanted. So that would be the general advice I would give someone if you want to look for a money manager. But that takes some work in figuring that out.
And what sort of bankroll do you need to be working with for that? Like, what's the point of your savings where you're like, okay, I should put XYZ into this, and do you have any like personal finance tips, basically?
So for full disclosure, right, I'm not a financial planner, so that is not my expertise. So this is just my personal opinion. But I think people should focus on making like that first, $100,000, $200,000 of savings. That's the hardest.
Yeah.
If you have $10,000 in savings, instead of, spending all this time investing, like that's not where you're gonna make your money. Go look to start a business, go have a new side hustle, like go create something to get to that $100,000 to $200,000 in cash that you don't need. Life becomes way easier if you can have that. Because if you have $10,000, even if you have a good track record, so great, you turn 10,000 to 50,000, over 10 years or something. If you turn 10K to 50K over 10 years, that's a fantastic track record. It's not going to really change your lifestyle though.
Right.
But if you turn $200,000 into $1 million in that same time period, that will change things.
Mm-hmm.
So, but if you have say like 100K or more, then I'd say you should be serious about investing that capital.
Yeah, that's kind of what I was expecting you to say.
Yeah. Yeah. I would say if you have capital and do have some time on your hands, one way to kind of jumpstart that would be to buy a small business and run it for like 4 or 5 years. If you go onto these business brokerage websites or Biz Buy Sell, which is the big one, there's some small businesses that there's nothing wrong with them, and they're selling at like 2 times earnings. So essentially, if the company never grows again, that would be about a 50% annualized return on your money. That's really good.
Yeah.
So I've known a few people that have done that, where they bought, 1 or 2 businesses that, maybe take, 10, 20 hours a week to run. They're essentially buying a job.
Right.
They can sell the company at some point. I have a buddy who had a friend who bought an ice cream. The guy's like pretty well to do. He bought an ice cream shop and ran an ice cream shop for a few years. But look, if you pay, say, let's say you have a $600,000 business or something, or $500,000 business, and you put down $100,000 to run it. It's a pretty stable business. I mean, those returns are pretty damn good, and it doesn't take that much capital to get in on running the business, and then all the money is pretty much going to your salary or to cash flows to you. So that's another interesting thing to do.
The other cool thing about that too, it's one of those things that people just don't think to do. So I think there's a big opportunity there. Like people aren't.
There's not a lot of competition, especially with those businesses, because, and I've noticed this, right? If you're looking, if any of your listeners go to bizbuysell.com, if you look at these, like, a business for sale for like $10 million, $18 million, right? The valuations go up quite a bit. Those companies can go for 10 times cash flows. But look at a business that's like a $200,000 business, a $300,000 business. A $300,000 business might have $150,000 in cash flow.
Right. That's a very nice paying job.
Yeah. So I've come close. I ended up not doing it.
I think people sell businesses all the time, and a lot of the time when they sell, they just need to get out, and they're willing to sell it.
That's right. That is
like
right.
A fire sale real estate, for example. Like, shit happens in their life, they got to sell it. They're going to sell it for, change on the dollar. So
yeah. So, or they just don't want to, do the the work anymore, and they just want the cash.
Right.
So, they're not going to get a great, and that's the thing. If you bought an ice cream shop, you might sell it, say you run it for 5 years, you sell it 5 years later, you might sell it for, just a slight premium to what you paid for it, but you got all these cash flows out of the business. So it ends up being a pretty good return. But that's always an option too for people.
Yeah. Yeah, it's interesting to kind of think in those terms because it just doesn't occur to most people. They're like, I can't buy a business. I don't know anything. It's like, sure you can.
Well, you know what it is that, it doesn't matter if I'm talking about a private business, a public business, real estate. To me, all that matters is two things. Well, really, it's one thing. It's your rate of return. Now, and if you can make a good return taking very low risk, that's the sweet spot. Now, the reason some of these small businesses have higher returns is that you are putting time into it. And then how much is your time worth? When you figure that out, they're often still good investments. But, there is a return on your time too. So you are getting compensated for that. But public businesses, right? They already have a CEO. They already have a management in place. They have employees. You don't have to do anything, and so you can run your own little holding company of tiny slices of different businesses. If you can buy them at a good price, which is the key word, a good price, you'll do very well for yourself over a few decades.
Are there ways to buy those businesses without having all the capital up front? Can you finance those sorts of things? I'm guessing.
Well, if they're public, you don't need all that capital up front. I mean, but then again,
enough to control it, right?
No. I'm saying if you buy, one share of Google today, right? You want to,
okay.
Yeah. But what I was saying before is if you have such a small amount of money, like you could, but that's not what's gonna really change your lifestyle. Even if you're doing 20% annualized, it's still gonna be hard.
Right.
So get to that first $100,000, $200,000 in cash for however you can do that, and then really get serious about investing that capital. And see that's where it's stupid. It's almost stupid to try to keep hustling because if I'm not saying it's stupid, but the math just works out where even if you have like average returns, right? If you had a $200,000 portfolio and you're in your 30s, I mean, you're gonna be in a position that's way better than most people in their 70s by the time you're in your 70s. I mean, that's just basic compound interest. And then if you can do an extra percent or two more, you're in a really good position. And people are blown away. I mean, this is such basic math. But, use the compound interest calculator and figure out, if you have 100K and adding a few thousand every year, 9% or 12%, the numbers start to get ridiculous. Yeah. Which is also mind blowing when you see how many people are in their 70s and aren't worth over $10 million. Like to me, if you had 100K and you knew how to invest, it would be really hard to not be worth $10 million plus by the time you're in your 70s.
Just by simply putting
math
a year into that.
I don't know the exact math, so don't quote me on that. But
right.
I mean, look, I'm gonna look something up. You can edit this part out, but right, if I'm going on moneychimp.com, right? So if I had say 200,000 in current principal, right, and I added, say, I was able to add 20,000 a year, and save. So if I'm making $100,000 a year, I save 20,000 of that. I give it 50 years to grow, and say I can compound that at 12% a year. That's $111 million.
What about 20 years?
In 20 years, doing that same calculation at 12%, that would be $3.5 million. If you lower it to 10%, that's $2.6 million. If you lower that to say 8%, that's $1.9 million. I mean, so again, the math gets an 8% return is not that great, and you're still worth close to $2 million in 20 years from that.
Right, and that's pretty easy. Say if you're 40, you're trying to retire at 60, you save 20 grand a year. You got over, what did you say, $2 million?
I said so if you had starting principal of 200K, $20,000 a year added, 20 years to grow at 8%, that's $1.9 million.
Yeah.
And if you could do 10% a year, which has historically been the average, that's $2.5 million, $2.6 million.
Right.
And then if you give it 30 years to grow versus 20 years to grow, because ideally you're not going to be spending all of that at the same time, that's now $7 million.
Not bad.
Not
Pays
bad.
to
If you had,
save.
yeah, and if you add 30,000 a year, now you're at about 9 million. So these numbers get pretty big.
Yeah.
Or, if say instead of 200,000 principal, you had 300,000 to start, now you're at 10.6 million just after 30 years.
Can live on. You can retire on that, I think.
I think you'd be okay. Yeah.
Yeah. So where can, first, where are there any other like mindset pieces or any counterintuitive things about investing that you think would benefit the listener?
Sure. Few things. One would be that people tend to overpay for certainty and underpay for uncertainty. And, if you look at the way just our minds work, right? If something is uncertain, right, and we don't, we're wired to see patterns, or we're wired for predictability. So when something feels uncertain and unpredictable, it creates a level of anxiety for people. So an example of that is, if you have a U.S. government 10-year bond, right, yielding 3% or 4% or whatever, you are certain to make that yield. It's certain. That's a horrible return, but people do that every day. However, if you're buying, say, a very speculative biotech company, that would be very uncertain. So if it creates some cancer drug, you could make 100 times your money, right? So you're getting paid if there's uncertainty. Now, in the example I gave you, the biotech company would be very high risk because the downside is zero. However, if I said, here's a biotech company with a drug that possibly could get approved in the future from the FDA, and they have $20 million of cash on the balance sheet, no debt, and the market cap is 15 million, so you're paying less than cash for the business, it's still uncertain, but now it's not risky anymore. So the sweet spot is if you can find situations that are uncertain, but also low risk, right? So even though there's all these range of probabilities, even in a really bad case scenario, you're not going to lose a lot of money, which goes back to rule number 1, don't lose money. Rule number 2, don't forget rule number 1. That's a really good way to make money because it allows you to stay in the game. And on occasion, you'll hit a home run by accident. Mm-hmm. But you want to be around and hit those home runs. Or, if you invest in a speculative security, you go to zero, well, you're out of the game. So part of the game is being able to just stay in the game. And if you do this again, if you're doing this for 30, 40, 50 years, you can't get wiped out. You have to be vigilant against wiping out. But that does not mean you have to take low returns. So if you can get a low risk, high return, which is kind of what everyone ideally wants, you need to be willing to deal with uncertainty. I mean, it's almost guaranteed. Because the things that feel good psychologically and that give you certainty will almost inevitably be things that you overpay for and give you a bad return.
You need to have that risk tolerance.
Well, no, you have to have the emotional tolerance. It's not risky.
Okay.
I would say it's certain that Austin population grows the next 10 years. I do think that's risky to buy Austin real estate. It may work out. You may look at this podcast 10 years later and it works out, but it may not work out. If you buy something at a 2% cap rate and there's 5% price appreciation, that's a 7% return. That's a lot of risk for a 7% return. Yeah, I could find things in the stock market with almost not no risk, but almost no risk for a 7% return, which I'd feel much more comfortable with. You can buy real estate with 8 cap rates, so who cares if it doesn't appreciate in price? If, let's say, it appreciates with inflation, let's say long-term inflation is 3%, that's an 11% return with very little risk. So there's you could say that risk has nothing to do with an uncertainty or certainty. What risk has to do with is what's my possibility of a permanent loss of capital. Buying a 30-year treasury today, and if we were talking, say, a year ago, buying a 30-year treasury where interest rates were very, very low, was very, very certain. But I would say that was very, very risky because you had an inflationary risk. You're locking in terrible returns, and you're certain to lock in those returns.
Right.
So that's one principle, is the low risk, high uncertainty way of thinking about things. And there's a book that elaborates that. My colleague Monish Pabrai wrote a book called The Dondo Investor, where he talks about that mindset in more detail. Then that's one principle I can think of. The other thing is not to get so hung up on, the kind of asset you're owning. Just because something is real estate doesn't make it a good investment. And just because something is oil and gas doesn't not make it risky. So there's, I think a lot of these mythologies are around because people always know someone who invested in some, speculative oil and gas company. Most people who buy real estate, especially if it's good quality real estate, you're going to make money. The problem is if you actually looked over like a 30-year return of some of these homes, it's like, oh my God, my house is tripled. It's like, okay, that's a 5% return. It's not actually that good.
Right.
But the benefit of real estate for a lot of people is that it forces them to hold, because they're not, you can't go in and out of real estate every week.
Right.
So if you're holding something for a long time, you can see it. The thing with the stock market is you can't necessarily see it, right? You have to visit the company. And, casinos, right, they make their money off not being able to see the dollars, right? You have chips. It's very easy to do stuff that you wouldn't do if those were dollar bills.
Right.
So with stocks, it's like you can buy a stock with no research. You can sell it 10 seconds later. If you were buying a farm, you would never buy a farm because you liked soybeans and then sell it a week later because something happened in Greece that was unrelated. But people do that in the stock market all the time. It's like a form of psychosis.
Right. Yeah, it's very difficult to make that mental link between the chips or the fake money to like the hard asset.
And so a stock is a hard asset. If you buy Google, right, you're buying, you're buying the employees, you're buying the intellectual property, you're buying all the AI systems. That's a real thing. If you bought Coca-Cola, you're buying a slice of the machinery, of the warehouses, of the network, of the territory partner. Like, you're buying all that stuff. But people just see a little ticker symbol moving around.
Yeah.
That represents
Maybe
that, but that's illegal.
It'd be a stupid, ridiculous exercise, but build a little model of the thing you buy, put it on your desk, and fuck, this is my thing. I think it would just help.
Well, that's why I tell people, that's why I say go read a corporate report. Because, if you own one share of Coca-Cola, you are a partner in the business of you own a part of Coca-Cola, and that's your company.
Should tell girls I own Coca-Cola. Yeah,
you could tell girls you own Coca-Cola.
I'm an exec at Coca-Cola. Well, cool, man. I've learned a lot. I really appreciate all the insights and the help. Where can guys find you if they're interested in learning more?
Yeah, so I have a website. There's not much on the site. There's like a few case studies. Haven't updated in a while. But you can go on the website. It's gscm.co. But if you really want to get a hold of me, I'm very active on Twitter. It's just my name, Eric Schleien. I'm very active on Instagram, also Eric Schleien. So you can DM me, send me a Twitter message. I do check all my messages, and I do respond to all questions. And I love to teach. So even if it's just a question, I'm always happy to answer anything. The only thing that is off limits is I don't give specific investment advice. So do not reach out to me saying which stock should I buy or anything like that. I don't engage in those conversations. But anything else, I'm always happy to help.
Thanks for listening. If you want more, go to innerconfidence.com and don't forget to subscribe to this podcast for the latest episodes.